Okay, welcome everybody to episode 61 of the Volatility Barometer. So we will get into things right away, but I do want to make a couple of quick notes here. The first thing is today we're going to do things a little bit differently. I'm actually only going to do one segment because lately I've been diving into the YouTube analytics. Typically I don't pay much attention to those things, but I just noticed a few things. And it does seem like right around, say, an hour 20, hour 30, people start dropping off. So what I wanted to try to do is try to stick this inside an hour just to check the analytics, see if people are more engaged with that sort of length. I know sometimes we can go 2 hours. We've actually had live streams that ran over 3 hours. So ask your questions now. We will definitely do the Q&A. That's typically why it runs long. But just know today that I am actually going to keep an eye on the time. I'm not very good at that, but I'm going to try to call it within an hour. So that's why just the one segment today. And then, of course, your questions. And the other thing I want to mention really quickly here, of course, don't forget that with our VTS portfolio, if you haven't actually seen it before, if you're new here, welcome, of course. But this is today's daily email. And essentially what we do at VTS, I manage a portfolio and people follow along in the community. And right now we have 5 strategies equal weighting. So it can change over time. It's not always 5. But right now, 5 strategies equal 20% weighting. One of these strategies, the Iron Condor strategy, it actually does have its own full dedicated course. So VTS members can go through the course. It's pretty extensive. It's actually 30 parts. There's 30 videos. There's actually one still to go. Somebody came up with a really interesting question, so I'm going to stick another video in there. But essentially what it is a full course that you can learn the Iron Condor strategy. And for the first little bit, of course, I'll give you some examples. Obviously, the rules of engagement would be very important. We just go through all the rules of allocation sizing and what we're essentially looking for with Iron Condors. Of course, these things are important, the live trade instructions, but then it actually goes further and we get into things like, executions and how to get efficient fill prices, proper allocation sizing, stop losses, all these things. Basically, I tried to view it through the lens of somebody who's fairly new to Iron Condors, and they want to understand some of these things. And I can actually use the emails that I get from people to basically say, look, if 20 people are emailing me the same subject, probably I should make a video on it. So a lot of those were inspired by just a long series of the same question. What is high volatility, for example, why we trade longer dated contracts, wider wing Iron Condors. You get the point. It's actually a pretty detailed course, gap risk when we're going to run into troubles with Iron Condors, because it's not always perfect. But if you do want to actually join, all you have to do is sign up for the free 2-week trial at VTS. You will not be charged for the first 2 weeks, so it is a completely free trial. And I put a link in the description at the top of the page. Go ahead and follow that. You will immediately gain access. So if you're interested, just know that it is available to you. There's a pretty extensive 30-part Iron Condor course. So you can see here, this is our rundown for today. And essentially, I am going to touch really quickly on the UVXY because today is June 23rd, which means the UVXY did do its reverse split. It went into effect today. I'm just going to point out one thing that will be important for all of you option traders out there. And then we're going to go ahead and get into the real topic today. Essentially, when I believe, in my opinion, the only time you should ever consider going long volatility. Now, this might surprise you, but one of the most common questions that I get, and I literally every day, guaranteed, there's at least 5 or 6 questions in my email inbox regarding long volatility, right? Buying the VXX, buying UVXY, buying VIX calls, trying to catch that big epic market crash and make a whole bunch of money. For some reason, there is an allure there for traders that they really do feel like they're going to be the one that gets in and makes all that money. So I wanted to actually break down my philosophy on why this is typically such a bad idea. Because maybe 2 weeks ago in a live stream, I essentially stated that the only time I ever go long volatility is when the market is already crashing. When volatility is already at extreme levels, that's when you go long volatility. But a lot of people think that's counterintuitive. They think you should actually wait for volatility to get really low and then be the contrarian and jump in and make a whole bunch of money. I'm going to show you with data today why that's a bad idea, why it will probably fail, and again, back up my statement that the best time to go long volatility is when there is already confirmation that the market is melting down. So we will get into that. But with respect to the UVXY, the reason this is important, like I said, if we look at the price of the UVXY, $20, right? For the longest time, it was low single digits. It actually did finally do its long-awaited reverse split. Let me just show you the split history here, and you'll see what I mean. So 11 times now, here's the VXX if you're curious, but the UVXY did its 11th reverse split. So it happened when the UVXY made it all the way down to $1.98, a new record for sure. That's extremely low. No idea why it took them so long. But if you average out all the prices on the day of the reverse split, we can see a rather ominous number there, averaging out to 6.66. So I'm not overly superstitious, but there it is. But the $1.98 certainly was a huge surprise, and we've been waiting forever. But it did finally happen. So now the UVXY is at 20. Look, if the market remains stable for a little while, it's going to do another reverse split pretty soon anyway. But the one thing that I wanted to point out for all you option traders, remember last week's live stream, and I told you all about what is going to happen with the UVXY. And now we can see it here. Remember that I said all of the old option strings, every one of them, when you wake up on the 23rd, they will all start to say 10 over 100. What they will typically say is just 100. But what this means is there was a 10 to 1 or a 1 to 10 reverse split. And we can actually use the VXX as a proxy here because it did its 4 to 1 reverse split, or 1 to 4, sorry, about 3 months ago in March. And you can see there are a few of those option contracts left over from the old string. These ones are going to say 25 over 100. If I go into here, you can see how low these prices are. 5, 6, 7. VXX is at 26 right now. So this is the old options, and they just stay there. There's a reason with, the way that options clear, it's actually pretty annoying to adjust the options. Of course, with the shares, you just multiply by 10 the price, and then you divide the share count by 10. But the options are not that simple. So what they actually do is they leave the old options open, and you can, if you have options open, you can always close them out. And then the new ones, the market makers will start to make them, and they will all say 100 beside them. So the 100, of course, is because one option contract is equal to 100 shares of the underlying. But right now it's going to say 10 over 100. Every single one of these is the old cycle. So if we go into one of these, you can see the prices, $1.50, $2. This is not a current brand new option string. So you definitely want to avoid these ones. I would imagine it's really not going to take very long. My guess is by Monday, possibly, but for sure Tuesday, Wednesday, Thursday, you're going to start to see those new option strings. They're going to say 100 next to them, and those are the ones that you can trade. Now, liquidity means something a little bit different in the volatility space than it would, say, in the stock market, but just best practices, I would still hold off a week or so before you start jumping into those new contracts, just for specifically for exit liquidity, especially. I just don't like to get into them right away. The VXX is perfectly tradable right now. So perhaps, obviously you can do what you want, but I would say give it a week or two, and then we can all start trading UVXY options again. But just note that if you have options that are existing from the old ones, certainly now, if you haven't closed them already, like I warned last week, certainly now you would probably want to close those out and look to the VXX to open materially similar positions. So that's my recommendation to everybody. But let's get into the real data. Okay, so like I said, I personally believe, and of course I have data to back this up, that the only time people should ever really be going long volatility is when the markets are already crashing. Now, of course, this doesn't apply to anybody who's using it for hedging purposes. I won't get into that. I don't know what your portfolio looks like. I couldn't possibly say that you're hedging correctly or incorrectly. So we'll leave hedging out of it. Pure speculation. It's actually not a very good idea to trade the VXX or the UVXY on the long side. And it's probably not going to be overly difficult to figure out why that is. Of course, we've all seen the long-term chart. This is what it looks like. So I don't know what makes traders think that something that is down 99.99% since it launched, for some reason people think they're going to be the one that gets in there and threads the needle and buys it at the perfect time, and they're going to make a bunch of money. But typically, in in my experience with my email inbox, probably a good 95% at least are just people who frustratingly bleed capital over time. And eventually, after a few months, they'll email me and ask me if we can figure out how to fix the broken trade. It's kind of a nightmare. But no surprise, going long volatility is a notoriously difficult position to make money on. So what I'm going to do, similar to last week, we're actually going to do this from a VIX index perspective. Sorry, not last week, maybe a couple months ago. What we did is we divided the VIX index into quintiles, which is 5 equal segments. And then I showed you what a short VXX position, how it performed in each of those 5 quintiles. So remember, these are the results. Some of those segments actually performed quite well. Remember, this is short VXX, so that's the opposite of that trade. It's not overly surprising that there is profit to be made on the short side. What we're going to do today is the same thing. We're going to break it down into the quintiles, 5 equal ranges, 20 percentile each, and I'm going to show you what long VXX looks like in each of those segments. And I don't think it's going to be difficult for people to anticipate. They're all going to be bad, but there's varying degrees of bad. And there is one specific area that I want to highlight as a potential time to strike for all of you that just really feel the long vol trade is going to pay off at some point. I've got some actionable advice for you to take later on. So we should probably just very briefly touch on the VIX. I'm sure everybody who's watching my live streams probably knows what the VIX is, but it is worth talking about the ranges and whatnot. So, of course, the VIX, it reached a low of 914. It can go as high as 82. And, of course, if we use the old VXO calculation going back to 1986, in the crash of October 1987, the Black Monday crash, the old VXO went from 30 the day before it happened, which was already a very elevated position, to as high as 172 intraday. So that's one thing that I can debunk here. A lot of people think the VIX tops out at 100 for some reason. It doesn't. The VIX is just a pure calculation based on S&P 500 options, and it can go as high as it can go. So don't think that, oh, wow, 82 is the highest it can go. No, it actually has a precedent of going up as high as 170. So it even closed that day at 150, which is bizarre. But if you want to see, the long-term mean, of course, the mean is just if you add up all the numbers and divide by how many there are, 1966. This is why you'll oftentimes hear people say that the average VIX is 20. I disagree. I don't say the average VIX is 20. The mean is almost 20, but I think the median is probably much more appropriate with the VIX because, of course, these high ranges, it can really bring up the long-term average. It's not very meaningful to use values, in the 70s and 80s as an average. It very rarely happens. So the median is 1744, but I even like to highlight a little bit further that if we use the mode, which is the most common occurring number in a sequence of numbers, we can see that a 12 handle of the VIX is the most common number. So 11, 12, 13, and 14 are the most common ranges, which means the VIX does like to stay in those low ranges. A lot of times people get confused by that. Oh, the average VIX is 20, and they think a VIX of, like right now, 1289. They think it's insanely low, like it's going to spike any minute now. The market's going to crash. Actually, no, the VIX is very comfortable down in the 11s and 12s and 13s. So, it's not a prediction. Maybe next Monday the market will crash, but don't think just because it's low that it somehow has to crash. That's just not the case. But remember, what we're going to do is we're going to divide this up, and I'm going to show you long VXX during each of those 20th percentile ranges. And this is your results. So like I said, it's not going to be surprising that all of them are terrible. But if your eye is catching a certain color here as a potential tiny little diamond in the rough of potential, hopefully you see it now, but I'm going to go through each one of the 5 segments, and you can just hold it in your head which one of those is the most interesting to you. So, of course, the red one is catastrophic. I don't know if you think that there's potential there, but which one of these are you eyeing, looking to, hey, maybe there's a shot for us long vol traders? So the first segment, this is not surprising. It's going to be negative, but the VIX doesn't actually get down below 1286 super often. Now, when it does get down to that level, For some reason, this is when everybody starts to think, you know what I'm going to do? I'm going to be the smart one. The VIX is at 12. I'm going to jump in there and buy the VXX because, of course, it's at 12. It's going to spike any minute, right? Well, like I said, no. This is oftentimes one of the things I say, one of my quotes that I write in my blog articles and, on Twitter and whatnot. Low volatility begets lower volatility. What you will find with volatility in the market and stability in the market is that once you catch those longer term trends, that is actually making it slightly more likely that it will continue going forward. So if you think about a year like 2016 and then leading into the entire year of 2017, once volatility caught that low trend, it stayed there for over a year. I can't tell you how many people emailed me saying that they're just taking devastating losses with their long VXX. They were sure once the VIX got into the 10s that it was going to spike. That is not the case. Statistically speaking, you're just going to bleed your capital because it gets low and it can stay there for extended periods of time. This range from 20 to 40, again, I don't think this is overly surprising. From 1286 to 1519 or 1529, that's a very stable market period. There would be no reason why a long volatility position would do well there. You're basically relying on pure luck if you're going to buy volatility at that point, because it's very unlikely to be spiking. You would have to just, for some reason, have timed it perfectly. And of course, luck exists in trading, but it's not a very good long-term strategy. So that's not a good segment. This one is only slightly interesting, and it's only because here it does appear like there was a little bit of hope for those long vol traders. Now remember, the inverse of the short VXX was also interesting here. Most of the time it should do well between the 40 and the 60th percentile. But in the last 5 years, it certainly has not. And the long volatility in the last 5 years during this segment actually did show a little bit of promise. So why is this? What's happening here? Why is, that middle range of the market showing promise for long vol, but devastating for short vol? If you think about what's happening in the last 5 years, the market is reasonably unstable, right? There's probably just as many bulls as bears. There's just as many people think, we're over the pandemic, we're going to have a good market. There's just as many people who think it's going to crash any minute, like recession imminent, it's coming, yield curve inverted, all that stuff. So what happens? Well, the market has a very difficult time catching longer term trends. It bleeds down because markets tend towards stability. Keep that in mind if you're a long volatility trader. You're already in the hole because markets do trend upwards and volatility does weigh down long term. Like all else being equal, volatility is coming down. That's just how it works. But what's happening now in the last 5 years, when the market gets those periods of stability and the volatility starts declining, when it gets to that middle range, that's just right about the time it's going to actually reverse. But that's only a short-term occurrence. That's only during the last 4 or 5 years. So that's why you're actually seeing some type of glimmer of hope here where it's actually going up. This is not going to last. If the market becomes stable again, that's going to dry up and you're going to see again these 93% drawdowns. I'm not trying to represent that this is anything good. I'm just trying to explain, given the nature of the market the last 5 years and how difficult it has been to catch a long-term trend, that's why that's happening. This one, obvious disaster. Why is this? Well, I just said that volatility, all else being equal, trends downward. Markets trend upwards. What's happening when the VIX is between 18 and 24? Well, nearly always it's going down through that range, not up through the other side, right? 9 times out of 10, it's coming from above 24, crashing down the other way. So if you're going to jump in on that long vol trade in this sort of mid to high range, the vast majority of the time the train's going the opposite direction. You actually want it to go the other way. So this is the worst segment, 99% drawdown. That is not fun. Okay, so I kind of led with this. Hopefully this 80 to 100th percentile range is catching your eye. Like I said, of all the colors that you were staring at here, there's only one of these that's actually accomplishing our intended goal. Remember, when you're going long volatility, hopefully your goal is to catch an actual market crash. You're not trying to make a few pennies if the market sort of drifts down slowly. What you're trying to do is catch those very rare times, financial crisis, 2008, Volpocalypse, Q4 2018, the pandemic in 2020. That's what the long vol trader is focusing on. So there's only one of these segments that even comes close to capturing those, right? All of the other ones are non-starters. There's no money to be made here on the long side. This one is interesting. Now, obviously it's not good. 98% drawdown. This is terrible. But is there anything we can do with the fact that it did catch those spikes? Of course, you gave it all back afterwards, but it did catch those spikes. So I've actually done a previous video here. It's not quite the same thing. This one is short S&P 500 during VIX futures backwardation and why it doesn't work. So remember, VIX futures are in backwardation about 16% of the time. So what is happening when you get those peaks? Let me just go right to this one segment. Did it play? There you go. The dreaded give back. I call it the dreaded give back, and that's essentially what you're seeing when you get these insane rises. This is a 4-time spike in your money. This is a 4-time spike in your money. But why did you give it all back afterwards, right? It goes up, you think you're a hero, and then it crashes down. Well, what is happening is the dreaded give back. Imagine this. You caught the pandemic spike. You rode it up with long VXX because you waited for those higher percentiles, like I've been saying, and you actually caught it, right? The market's going to recover at some point, isn't it? I mean, it's not going to crash forever. It's going to reverse course. Sometimes violently, sometimes it can be a V bottom. Well, what's going to happen in that case? Volatility can remain very sticky on those high ranges. So what ends up happening is the very same signal that got you into that long volatility trade, which is extremely high volatility, it's the same signal that keeps you in the trade long after the market has started to recover, because volatility will remain in those very high levels for days, perhaps even weeks. So that's what's actually happening. You're getting in, you're getting your money, and you think everything's awesome, but that same signal is still there. It's still raging high volatility, and you're going to stay in your trade, and then you're going to give it all back because the market's going to V-bottom. The government's going to do some type of stimulus package, or the Fed is going to come in and promise everybody it's going to be okay, and you're just going to watch all your money crash. And 2 weeks before, you thought you were rich, and now you lost it all again. So what I wanted to talk about is just potential ways to possibly mitigate that give back. So this article on my website, this is article 637, ideal long volatility trade frequency for tail risk, right? This is essentially the heart of what we're getting at. This isn't exactly using the VIX, it's actually using the VIX futures for the VIX futures backwardation. But the first chart here is, what if we just went long vol only when the VIX futures are in backwardation? Well, this is what the results would be. This is not good. Obviously, this is terrible. Nobody could trade this. It's too much. That's 16% of trading days. You're going to go long vol. That's too much. What if you dropped it down to 10%? Well, this is a little better, right? The long-term terminal results are almost break even at this point. And we're starting to see those spikes, which means it is doing what we want it to do. We did catch the financial crisis. We caught the European debt crisis. We caught the China scare. We caught the Q4 crash, the pandemic. It's doing its job, but there's give back extreme on the other side, right? What if you drop it to 5th percentile? Right now, you're only going long vol 5% of the time. Well, you're still got a lot of give back, but you can see the terminal results are now positive. It's getting in the right direction. This is what we should be focusing on. What if we drop it down to 3%? You're going to be very disciplined, and you're going to wait for only the highest percentiles of volatility. Well, now you actually got to keep a significant portion of your money, right? Not all of it. It's not perfect. No signal is. But this is really the only time where you can ever make money going long volatility. What happens if you drop it to just 1%? This is the lowest first percentile of VIX futures contango, which is minus 15%. It doesn't get there very often, but when it does, guaranteed the market is absolutely melting down. And that's when you can jump in and you can hopefully catch a trend for a week or two, get one of those long-term trends, and then hopefully it kicks you back out into safety, because when the market bounces, remember it's going to be violent, and you don't want to be holding long VXX while the market's recovering. So be careful of that same signal. Another thing that you can keep in mind, again, I'm trying to give you actionable ideas here so you can do your own research. One thing that we do personally, one of our strategies, which is called our tail risk strategy, you can see here, we don't use VXX, we use the VIXM. The VIXM is a different volatility product that tracks the M4 to M7 VIX futures. VXX tracks the front 2-month VIX futures. So the VIXM actually moves slower. And so what could that do for us? I showed, this is using my Volatility Barometer, what we do actually within our actual strategy, holding it above the 80th value, which is about 5% of trading days, because my barometer doesn't ever go all the way to 100, doesn't ever go down to 0. You can see the ranges right here. But anytime it's over 80, you can see we're just trying to catch all these little peaks, right? That's all we're interested in with tail risk. All of this garbage, you're just going to lose your money. You're just going to bleed capital for weeks or months. Then you're going to have to email me and ask me to fix your trade for you. So we're only trying to capture these peaks. Well, here's the 1/2 VXX. You can split it in half. And so that when you get caught on the other side, your give back won't actually be as severe. That's the first thing you could do. The second thing that I showed you could do is use the VIXM. The VIXM is in red. You can see the results are even better. You get to keep a little bit more of your money. But the last thing, hopefully some of you, when you're watching my live streams, I want you to learn something and take it and do your own research. Hopefully one thing you're thinking of is, well, what if I started adopting some type of mechanism to scale out of the trades while the market is still crashing, right? Why do I have to wait and use the exact same entry and exit signal? Actually, couldn't I just make a bunch of money and then find some clever way to exit your trades? You could, possibly. That's what research is for. So what I do within my strategy is I do make rolling adjustments. So if I am in a long volatility trade, I already know that give back is coming. I already know that it's going to look disastrous. It's going to be one of those things where it spikes and then it's down, because that signal is going to affect me just as much as everybody else, right? That give back, nobody can escape from it. It is coming. The market will bounce before volatility starts to come back down. So you have to adopt some type of system where you can start progressively rolling out of your positions or adding different positions. I will leave it up to you for doing your own research, but I'm just showing you that the fact remains, this is the only area that shows any promise whatsoever. So another thing that I did using the VIX, which is a terrible indicator, but we're using VIX quintiles. There's the 97th percentile. What if you were patient and you just did the 97? I just ran the numbers on that as well using the VIX. It's not great, but again, think about what this could potentially represent if you had a way to cycle out before you give all your money back. That's what this is showing. It is positive on its own, but I think all of you, especially those people who watch my somewhat boring live streams about volatility and all these trading nonsense, probably you can think of some ideas here to maybe try to keep a little more of that money. The last thing that I want to show, and this is hopefully going to drive the point home, because I know a lot of people are going to be like, well, you cherry picked the top 3%. What happens if I just wait until the bottom 3%, not the 20th? What about just the bottom 3, right? The top 3 was the best part. Is the bottom 3 worth being a contrarian? So I also ran the numbers so you could see that. Third percentile, when the VIX is below 1050. Well, I hate to break it to you, but this is not going to be very good either, because of the same reason. When volatility got low right there, this long vol trader started to think they're the smart one in the room, and they're going to be the one to buy the long vol and catch this big spike. Well, turns out volatility can stay low and progressively bleed lower for a very long period of time. So that's actually what's happening during the long vol trade. This is why I said last week, I've said this for years, I don't play the contrarian. The trend is your friend, especially with volatility. It does trend down over time. Short vol is the right side of the trade to be on. Of course, you have to hedge, you have to have layers, you have to have an actual clever strategy, because there is danger lurking there every single day you go to sleep. If you're on the short vol side, there's risk there, but it's the right side of the trade to be on. Long vol is only good for very strategic positioning, in my opinion, only when the market is completely melting down. And then the trick becomes, how are you going to get yourself out of it before you, for 2 weeks, become a rock star, and then the next 2 weeks, just give it all back, right? The dreaded give back. So that's why I call it that, because it's real. And I can't tell you how many people, you know, you might be a guy who's on Twitter a lot, bragging about all the money you've made going long VXX. I've seen it. There's actually signal services that really ramp up their marketing during that week or two where they're making a bunch of money with the long VXX. And then you go back and check their results 3 weeks later, and they're worse than they were before they started ramping up the marketing, right? This is kind of a side tangent, but this is one of the very dangerous things when you're following these vol traders, because what would happen in that case? Well, the marketing gets ramped up to an extreme when they're up 100% on their long VXX position. It's all over YouTube. It's all over Twitter. Join my service. Quick, buy now. We're making a ton of money. People join then, and then they give all the money back. Well, somebody who was a subscriber of that service 2 weeks before the spike, they are made whole. They ride it up. It spikes back down. They're not happy, of course, but they're at the same level. But what happens if you were not a subscriber here? All of that 1 week of marketing got you into the trade, and then you started following the trades, and you're down 50% in a week, right? That can legitimately happen to people. So this is just, and I do, of course, run a subscription, so I would also say the same thing applies to me. Be wary of joining at like ultra peaks. I don't do much marketing. I'm not really that type. People know how to find me, and you know, I kind of do this just to build my own body of work. But you're not going to see me all over Twitter saying, you know, join now, look at all the money we made. I've never done that. But you do want to be wary of joining if there's long vol money being made, because it can be fleeting. It can be very short-lived. Be very, very careful of that. So a lot of nightmare stories I've heard of people joining other services. Like, this guy said he was up 100% last week, and I'm immediately down 60%, you know, in 4 days. It can really happen. So watch out for the dreaded give back, everyone. All right, let's try to dive into these questions. Hopefully there's something specific to my presentation, but doesn't have to be. If you're curious about, you know, what happened there? My camera turned to the wrong camera. Anyway, ask me anything. Doesn't have to be specific to what I just talked about, but here we go. Uncommon sense. Good name. I like that. Does the volatility barometer use other VOLI data inputs, such as 7, 15, 60, 90, all the different variations of dates? No, it does not. If so, how? First part of the question, no, it just uses the VOLI in a couple of different situations. So I do use the VIX, the cash VIX term structure, the VIX 9D, VIX 3M, 6M, 1Y. I use all of those, but the VOLI itself, no. If anybody's wondering what the difference is here, it's actually quite similar. And truth be told, the VOLI is probably a better volatility index. The VIX index tracks SPX options, right? It's a statistic, basically. It's not tradable, but it's a statistic based on S&P 500 SPX options activity. It's taking just a strip of all of the options, and it's factoring it all in, and it's spitting out what the VIX index is. The VOLI, let me highlight this question again. The VOLI is using only at the money options on the SPY, right? So that's the difference, is that the VOLI is using at the money options, which I would argue, and certainly the nation's people who basically manage the product, they would say as well that that's probably the more interesting section of the market for traders, rather than just a strip of everything that can be kind of skewed, and some people might even say gamed. The VOLI is actually a good indicator, but I only like to use the cash VIX term structure relations to one another. So we're not using any of the nominal values. The VIX, even the VIX 3M, 6M, the nominal value doesn't mean anything to me. It's just the relationship and the momentum changes between them all is what I'm actually using. Then you have another follow-up question. Does the volatility barometer use VOLQ data? No, it does not. I do like the SDEX and the TDEX. So they are factored into the barometer a little bit. I would say maybe 5%. not overly influential, but again, the VIX index is measuring all options, the VOLI, the SDEX, the 3 standard deviation on both sides. If you start to use these in conjunction with one another, you can start to isolate certain areas of the volatility market, which might be more interesting to you, rather than just looking at an entire strip of VIX options or S&P options. Not overly useful. Okay, it's great. The shorter it is, the more people will go over it. I assume you mean the live stream if I can cut it to an hour, which means I only have 24 minutes left to get through these questions. Yes, my back's slightly better, but it's hurt. But I did golf twice, so I'm good enough to golf. Although I can't say I golfed particularly well. Although I hit it decent. My putting's a disaster. It's a complete nightmare lately. And when I say lately, I mean for 20 years. But yes, I have to figure out why my hands, the moment I touch the ball, my hands just got the yips, my friends. It is not pretty. I played with a bunch of guys at the Emirates Golf Club over here. I'm in Dubai now. And I played with 3 guys. And I hit it pretty good. Obviously I can play better. I haven't played much in the last 20 years, maybe 20 games or something. But I hit it good enough that they're like, oh, wow, you hit a couple of good shots. And then I get to the green, and it's just like they just don't even know what to say. I don't know how many times I 3-putted. Birdie putts, this far away, missing them. Not even touching the hole. It's pretty embarrassing. Got to figure that out. All right. What does the number VX30 divided by VIX tell us? I don't know if that's a typo or if you're trying to ask a specific question of yours. I don't use the VX30 divided by VIX. I'm using a relationship between them that also factors in all the days to expiration. So if we go down to the dashboard here, I don't know if this is the one you're trying to get at, the VX30 to VIX roll yield. Remember, the volatility products don't actually care about the level of contango. This is just very surface level mistakes that a lot of people online continue to make and then repeat, is that there is some buy high, sell low dynamic going on here. It's really annoying as somebody who does education in the volatility space that some actual accounts that have followers continue to repeat this nonsense. They're acting like experts in the field, and they actually don't even know the very basics about how the product works. So the reason that I don't actually talk about contango very often is because it doesn't matter. That's not what's changing the value of the product. What's changing the value of the VXX, for example, is that it's holding both of these futures in various weightings based on the days to expiration. And then these futures and this spot VIX right here, it will converge to the same price on the expiration day. Now, I don't think causation is overly important here. I don't think it's useful to say that the VIX pulls the futures down or the VIX gets pulled up by the futures. I wouldn't assume any causation here, but we know that this one and this one are going to be the same. So what we're actually interested in and what really moves the product is where these VIX futures are going in the next few days, the next few weeks. That's what's causing the price changes in the VXX. If this entire curve shifts downward, the VXX, by very mathematical definition, will go down. It has to. Even if you had a curve that is in backwardation, as long as that curve drops down, well, guess what happens to the VXX? The actual shape of the curve doesn't matter. And this is something that, people often misquote. Now, it's true that if contango persisted for several weeks or a month or so, it would be very likely that the VX is, of course, bleeding down in that situation. But you wouldn't want to confuse that with any causation. It's not. It's not doing that. It's basically the VX30 is these futures based on the number of days to expiration and where it will likely be going forward, which is probably down here. That's why that every time we look at this diabolical chart, that's why we always highlight the fact that it's probably going down. And I can say that with reasonable confidence because these front two futures, this is a picture from months ago, but you can imagine the curve, they're probably going down, right? Which means the VXX is going down. It's not going down because it's selling this one and buying this one and it lost money somehow in the transaction. That's just it's just a misunderstanding of the math involved. You're using the same amount of capital to trade the same amount of futures dollar value. The notional value is not changing. Unless you have this massive new influx of capital, there would be no reason why switching the positions around is causing any inefficiency in the buying. That's not what's happening. So to get to back to your question, that's a whole long-winded way of saying, what does it tell us? It tells us the most direct measure of where that VX30 is likely going to go. It's going to go to the spot VIX, right? Unless something in the market happens. That's why we always add that little caveat, all else being equal. That's very important. But all else being equal, yeah, 2 weeks from now, the VX30, that constant maturity, it's going to go down unless the market crashes. But why would I think that, right? The VIX is in the 12s, market's very stable. I'm not going to be a contrarian. Look at the shape of the curve and look at the roll yield. They're probably going to meet down, to be honest. That's why it's important. The roll yield is the most important metric that there is for volatility traders. Which kind of begs the question, how can some of these so-called experts not really know that? I don't know how. Okay. Keep up the good work. Well, thanks for tuning in. I think some of your graphs are mislabeled, probably. Sometimes I try to, time constraints, I'm making videos, I'm editing, I'm managing the community, I'm answering, 4 hours of emails every day. Sometimes when I put these presentations together, it's quick, right? I'm basically going by facts that I know over the years, but as far as labeling and organizing it all, I'm usually a little bit strapped for time. So if there are labels, I'm sure you're right. And as I always say, all that means is that I'm impressed you're paying attention, because if you noticed it, yeah, you're probably paying attention, which is good. I like when people notice typos in my daily email as well. They'll email me and say, oh, did you notice that, this was wrong today? Think, nope, I didn't, but at least you were reading the email. So just to be sure I have it straight in my mind, all of your backtesting, the long VXX percentile examples, is based on the daily close. Yes. Yeah, we have terrible intraday data. For some things, it's possible that you could get some intraday data, but for us as traders, we're basically testing and analyzing data from many years in the past. And it's impossible to know what these values were at, 2:45 in the afternoon. So everything I do is end of day pricing. Just has to be that way. You can't even, open, you can get some decent data for the open, but even then you can't get it all. So I just default absolutely everything to end of day. Good question. What rolling period do you use to calculate M1 to M2 rank percentile? This goes all the way back to July 17th, 2006. You might think, well, that's a very silly specific number. Here's my daily emails. And all of these percentiles are going back to July 17th, 2006, because a lot of this data that I'm using for my inputs and certainly for the volatility barometer, they weren't all available back to the launch of VIX futures, which was March 26, 2004. I wish I could take it back to all the way to there, because even that's not a very long data set, to be honest. But there were a few of those public data things that weren't even available until that number, that very strange specific date of July 17th, 2006. So all the percentile ranks are rolling based on then. Unless sometimes I'm showing rolling 3, rolling 5, rolling 10, then it will be labeled as such. All right, ZIVB as good as the old ZIV, coming soon. We will see. I'm going to give it some more time. The volume's still very low, and I don't think it'll ever pick up, to be honest. The old ZIV was unpopular as well. But there is reason to believe that even though it was my former favorite volatility product, it didn't behave, the M4 to M7 futures didn't actually behave that well in the last 4 or 5 years. So I don't know. I'm still working through all the math on why that might be. I've got some theories. Probably I'll do a live stream in the future talking specifically about the ZIVB. It's doing fine. Like, it's performing as it should, it seems to me. I did notice a couple of days where the performance seemed to be a little bit jumpy. It was, there were some outliers that, based on the way the VIX futures were moving, it was a little surprising that it went up that much. But I'll dive into it, definitely. Right now, I would say, for me personally, I'm holding off. I don't have all the information yet. Problem with 99th percentiles, the data gets very small and thus harder to be robust, expecting the future to look similar to the past. That is a good point. And that is one of the things that we will always, in our lifetimes, suffer from. A lot of people think, like I just said, VIX futures goes back to March 26, 2004. Seems like a pretty long time. But when you actually think about how long a market cycle can be, from 2003 to 2007, I would call a cycle. From 2007 to mid 2009 is a down cycle. And then you've got a solid 13 years of what I would call a new cycle, interrupted by some crashes along the way. But yes, it's a very limited data set. So obviously all the rules of diversification and having safety positions and always being defined risk, all these things that I talk about, it's multifaceted for that reason. It's because you just can't allow arrogance to take over your trading. You have to acknowledge, like you are, that while the data does look robust going back, and I've also done it live, so I've actually had some good experience doing this, but I mean, we're talking about 13 years. Like I launched VTS in 2012. I started trading in 2005. Again, it might sound like a long time, but it's really kind of a limited data set, to be honest. 17 years is not that long in the grand scheme of trading. So always, always be careful. This is why a lot of people, my best strategy is the VIX options. My second best is the tactical volatility. The results are very, very good, right, over the last 12 years. A lot of people ask me, well, why don't you just put all your money in that? Well, that's the reason, because I'm not expecting it to just suddenly end and suddenly stop working, but I don't care how good something is performing for me. I don't over allocate to it. Even if it's making, like the tactical volatility, making 35% a year, I still don't over allocate to that. I still use my 5 strategies. I still use iron condors. I still use VXX butterflies. Return is lower for those strategies, but I'm not an arrogant trader to think that I've found the edge and I'm just going to dump all my money in it. I could be wrong. I could be it for me, just like for you. It could be the result of an advantageous bull market. It could be. So you don't ever want to over allocate, even if something looks very promising. And so you're right. When we do these testing and we look at these charts and we think, okay, well, yeah, all we have to do is manage the little give back and boom, there we are. Yeah, that's 2 positions going back 19 years. That's 2 instances. Financial crisis and pandemic. Not overly robust here. So obviously all of the position sizing rules are still in full effect. Okay. Just wanted to say you're not boring. Well, debatable. Really appreciate your time you put into this work. It's hard to find the info in the vol space that is current and isn't opaque. You're a hero. Thank you so much for tuning in and the kind words. I appreciate that. I agree to disagree. I do feel like I could, I'm not one of those YouTubers that there's lights and, they've got those soundboards that they're doing siren. I'm not one of those people. I mean, I'm almost 50 years old. I'm just going to present my data if people don't mind. I don't want to spice it up and try to act like something I'm not. You get me on the golf course, you get a few beers in me, I can be pretty fun, but on a live stream, you get what you get. How do you use the VOLI versus VIX and what ratio of the two tells us? Well, now you're going down a rabbit hole. There's many ways that you can do this, but as you've already asked a question about this, I already know that you know quite a bit about it, but one of the most sort of low-hanging fruit methods that you could use this ratio. So VIX versus VOLI. Let me just check that I'm not reading this wrong before I go down this long rant. Okay, VOLI versus VIX. So one of the ways that I tend to use it, it's great for option traders. If you think about what these 2 indexes are measuring, the VIX index, like I said, is a strip of all options on the S&P 500. The VOLI is only at the money options on the SPY, okay? That doesn't matter that much, the difference between SPX and SPY. But the at the money versus a full strip really does matter. So if you were to take the VOLI, the VIX minus the VOLI, right? The VIX is all strikes. The VOLI is at the money. What is that measuring? that residual that you get is going to be a number, right? Let's say the VIX right now is at 13. I don't know what the VOLI is, but let's say it's 12, right? That residual of 1, what is that representing? Well, if it's a small number, it means the out of the money activity on the S&P 500 is not overly robust right now, right? You would not be expecting the high option premiums on those out of the money strikes because the at the money and the out of the monies are kind of quite similar. But when you get a really big residual between these two numbers, it does mean that the out of the money activity on the S&P 500 is probably going to be paying quite a bit. So let's just take 2 option trades as a very basic example. One is a straddle option shaped like this at the money. One of them is a strangle option like this out of the money. Or you could do anything like an iron butterfly at the money, an iron condor way out of the money. If you get a very large VIX to VOLI residual, well, it might then be more advantageous to be selling the out of the money strikes and to be buying the in the money or the at the money strikes, right? If there's a residual that's very low, it probably means that you should focus your selling of options at the money. So maybe that, if there's a very low residual, well, there you go. You're going to be trading butterflies. If the residual is very big, you might want to sell those the strangles, right? You're selling very far out of the monies and you're getting paid handsomely for it. So that's one way that you could use that ratio. But I mean, use your imagination. Now that the nations is the issuer of the VOLI, they have the SDEX, the TDEX. They've got a whole suite of indexes that you can look at. So you don't specifically need this one per se anymore. But I was really, I wrote a bunch of articles about the VIX minus VOLI a while back. And, you know, the people at Nations, they were retweeting it a lot and they said the same thing. That's kind of what it's used for. And now they've got other things. You could look at the TDEX, which is a 3 standard deviation out of the money. It's kind of looking at the same thing, to be honest. But that's what it's used for. For me specifically, where are you going to isolate your selling of options? Where are you going to isolate your buying of options? There is also some data that I could go over in a future live stream that the actual VIX minus VOLI could be an indication of when the next market decline could be. There's actually, again, it's not overly robust where it's only, 17 years of data, but there is ways to use it as a basically counter trend signal to the market. So, but I'd like to unpack that further in a future live stream. So hold off on that one for a while, but that's an introductory way. Option structure, like there's no difference between all the option structures. They all have advantages and disadvantages. The real key, if you want to be successful, is when to use it and how to use it, right? That's one way to choose the right structure. Make sure you're selling the high volatility strikes and make sure you're buying the low volatility strikes. Little edges like that can really add up over time. All right, since long vol products like UVXY, why sell iron condors instead of selling call spreads? Is it because the put leg generates a bit more income relative to calls? Well, I don't trade iron condors on the UVXY. So, and not specifically that you couldn't, I have so many volatility strategies that already use the VXX, the UVXY. I don't need to add an iron condors to the list as well. But I'm not, again, like I just said, there's no real advantage or disadvantage one over the other. You can effectively use both iron condors or selling call spreads. Buying put spreads is the same trade by, for example. I actually prefer long put spreads personally. But yeah, there's no reason why. It just, does your system match up to it? When you're talking about a narrow strike gap, like for the UVXY, if you're taking literally $1 between them, one of them's a short, one of them's a long, there's really no difference there. There's no edge there. You're basically reducing the impact of volatility, Vega, and you're basically just doing a directional trade at that point. So I see no difference between the two. I think you could work either one of them into a system, no problem. The longer the stream, the more info we soak up, the better. Very true. Hopefully that's true. But I could also just come back in a few days, right? We'll see. The analytics will tell me what I need to know. Do you feel slower post 40? Have you considered testosterone replacement therapy? I'm feeling the effects of aging. So I'm basically 48 years old, but I've always been in good shape. I still run about, the equivalent of maybe 4 marathons a month. So I'm still active and I'm still in the gym. So lifting maybe 1 day a week. Sometimes I'll go 2 or 3 times a week, and then I'll take 3 months off. But I'm in good shape. I'm the same size, I'm the same weight as I was when I was 18 years old. So, but I've always been an athlete. My whole life I've been into sports and played multiple sports, competed in many sports, not just professional golf, but many sports, triathlon, swimming, all kinds of stuff. To be honest, the only reason I haven't considered TRT is hair loss, to be perfectly frank. I would like to keep what I have. And at my age, it's probably a losing battle at this point. At some point, I will think, you know what, I have heard that if you jump on TRT, you can lose your hair. And which is fine. I mean, half of men lose their hair anyway, so it's not like it would be the end of the world, but I still have a little bit. And so I'm basically, my forward sort of 5-year plan is, if I still feel pretty good and I still have a little bit of hair to hang on to, then I will delay the TRT. If I start to lose the battle with hair loss, which I would imagine will start to happen pretty soon, then there would be no reason why I wouldn't jump on TRT. Because I think that just for men in general, after the age of 40 and certainly at the age of 50, there's really no downside to it. You don't have to juice up like massive bodybuilder levels of TRT. You just try to maintain some type of 30-year-old levels, right? So that's the reason why it is, I suppose, pure vanity. I'm a little bit freaked out when so many people report losing their hair. So, not that I have fantastic hair anyway, but I've got some left, and at my age, it's not super common. So, what is the main dangers of a short call spread on VXX, UVXY, VIXY, etc.? The main dangers, no real dangers, because I would assume that your strategy also entails much smaller percentages of allocation. If you're talking about, let's say you have $100,000 net worth, right? And you want to start selling call spreads on VXX or UVXY, and you put half your money into a call spread, it's not difficult to see how this could go very badly for you, because it can spike up and you can lose your money. But if you subdivided your capital into many, many smaller chunks and you layered repeatedly as often as possible, try to get 1 a week, try to get 2 or 3 per month, and they're all very small, then single losses here and there, I mean, who cares really? It doesn't really matter at that point. So it is all in the position sizing. That's true of all strategies. You could take something that, let's say I tell you that this works great and I've got a 10-year track record and it's producing capital and it's reducing drawdowns, and I gave you the spreadsheet, right? I gave you everything and taught it to you completely. If you change a few of those variables, you could screw it up, right? It's possible to take something that works and just with a little tweak make it not work. One of the fastest ways to do that is to not understand position sizing. This is, I would say, for volatility traders on the short and long side, the thing that gets them into trouble the most isn't actually getting the trades wrong. It isn't actually the losing trades. It's the fact that they hurt so badly when they happen. That's what they're getting wrong. Now, of course, they're getting the timing wrong as well. They don't understand how the products work. But in large part, you can solve a lot of your issues by just taking very small position size. That's what I would say is, nope, not that one. There's no reason why you couldn't make it work completely. But you will get losing trades. Absolutely, you will get losing trades. So just keep that in mind. You will get some full losses. It will spike so far, so fast that your call spread will be nearly worthless by the time you wake up in the morning. That can happen. Position accordingly. All right. At least you said spread. I mean, if you said naked calls, I mean, just stop it. You know my answer by now. I'm not going to let you sell anything undefined risk in this market, in this world, in this cyber vulnerable world. Don't ever listen to anybody who says it's okay. Oh no, it'll be fine. Don't worry. No, it's not. That's just silly. Who would risk their future on such an unknown? It just doesn't make any sense. So yeah, I'm glad you said spreads. All right, I'll do a couple more. I'm already past the hour. Is a gamma squeeze in the VIX possible? No, it's just a statistic on the S&P 500 options. Heard a commentator today say that so many VIX calls has been purchased that market makers would need to buy SPX to hedge. The VIX action is not overly large, so I would not expect that to be true, and thus increase the VIX price. The only thing that increases the VIX price is the actual thing that it's calculating, which is the S&P 500 options market, which could be inconsistent, right? Yeah, the one thing that often confuses people, because there is about a 70% inverse correlation between the VIX and the S&P 500, people just often assume that, oh, the market goes down, the VIX goes up, market goes up, the VIX goes down. Well, what happens with the other 30% correlation? That's a big chunk of the market where they're moving in the same direction. What's happening there is the VIX is totally, agnostic to direction. It doesn't matter up or down. It's basically measuring the same thing on both sides of it. So you could get a situation in, say, from 97 to 2000, the run up to the dot-com bust, market's going up 20, 30% a year. It's just rocketing higher. The VIX was averaging 24 during that period. Well, why? Well, because it's not actually measuring just down. It can be up as well. That can cause the VIX to spike. So if that's what you're implying, in some roundabout way, that yes, it could actually be registering the S&P 500 call activity as well, then yes, you are correct. But as far as the VIX, it's not tradable. The VIX itself obviously has no volume, but the VIX complex itself is also small. You're not ever going to get, the tail wagging the dog, so to speak. I don't see any, not in a traditional sense of a gamma squeeze, certainly, because of course you'd need a tradable product to have a gamma squeeze. But as far as statistically, yes, it's a plus or minus indicator. It's just not saying it has to be just market down, VIX up. Shuffled dancing in a crop top will tend to, I would imagine that would, for the wrong reasons. But some people do crazy stuff. They, who's that one guy? I saw a pretty detailed documentary on, I think, is Meet Kevin. I think he's a real estate guy. His views just went through the roof when he dyed his hair yellow, I guess, like fluorescent yellow. It just absolutely skyrocketed his views. He basically made millions of dollars, indirectly, of course. I'm sure his knowledge is also on point. I don't know that to be sure, but because I don't watch his content, I'm not trying to suggest it was just the hair, but there's just a stark difference. As soon as he dyed his hair, like people just started gravitating toward his content. So interesting. My wife is still awake. She's in Macau. Time's it in Macau? It's 2 o'clock in the morning. Should I be worried? Wife's still out at the casinos 2 in the morning? I guess not. She's watching my live stream, so that's fine. Note, my question above, I meant to say UVXY declines. Missing word. It's hard to parse through these past comments. Selling iron condors, is it because of the put generates? Sorry, I can't, on the fly here, I don't actually know what you mean. If one has high risk tolerance, is it viable to replace QLD, SSO, and DDM with TQQ, UPRO, and UDOW? No, I would say no. I can't tell you what to do. If you're in the VTS community, of course, and you are, so of course you know that we do actually use, for our aggressive positions, we don't leverage any safety positions at all. So utilities is just 1 times utilities, bonds 1 times bonds, of course cash, gold. Anytime we use the treasuries here, and the same thing with the VIXM. It's a very slow moving product. But we will use the SSO, we will use the DDM. These are 2 times leveraged products. Now I do, of course, highlight directly that if you have lower risk tolerance, everything in the VTS works just fine without leverage. It's just, of course, a little bit slower, right? But hopefully my timing signals are good enough that we can use the 2 times. So the question becomes, and what he's asking is, I wonder, should you use all the 3 times products? I would say no. And I would say our results in 2022 should prove that to you, that while we have had some good recovery and some really insane performance, like for example, our defensive rotation is nearly back to where it was before 2022, but it did suffer, like a 44% drawdown. The QLD itself was down almost 70%. So we reduced that drawdown significantly, of course, but we were still down in the 40s as far as a drawdown goes for this strategy. If you were to use the 3 times TQQ, boy, you would have been hurting there. And what I fear is, even though the long-term terminal results would be better using triple leverage, there's no doubt that if you just were able to do this for 10 years and not touch it, you'd be better off 10 years from now. The reality is we are emotional people. Traders are not able to just not look at something. It's just not viable. We always overestimate our risk tolerance. We think that, oh, I'll be fine. I'll just use the 3 times leverage. Yeah, it'll go down, and then it'll recover really strongly as well. True, that will all happen. But when you're down 55% in a strategy, 60%, are you really going to just go to sleep and then wake up the next day and continue the process? No, probably not. You're going to pull the plug. And you're going to do the cardinal sin of riding it down to the bottom and then pulling the plug. I would rather you sell at the top, don't even start the strategy, or maintain everything and try to get that bounce. The only way that I can get you to emotionally be able to stay in the portfolio when it doesn't go well is to make sure that those drawdowns are minimized to the point where, if you imagine your risk tolerance is here, baseline is here. I mean, obviously trading is trading. You're going to have some really uncomfortable periods following even my portfolio that's quite stable. But I have to make sure that I don't ever get to the point where my drawdown surpasses your risk tolerance, because then you are going to pull the plug. Triple leverage almost certainly at some point in the next 5 years is going to cause you to make that mistake. So I would rather keep it 2 times or even no leverage at all and just ride it out. It's true that you might be able to squeeze an extra 5% a year out of it if you use triple leverage. Not a good idea. I cannot tell you what to do. No definitive, individualized investment advice, but my strong, recommendation is no, we don't need to be that impatient. We're trying to beat the benchmark if you can beat a buy and hold by 5%, you're going to, unless you're spending all your money that's coming into your household, you're going to retire a multimillionaire. Just save a little bit and outperform the market by 4 or 5%, and you're going to be just fine. You don't need to do that. Typically, when people try to chase, it's something that's happening inside your budget, something with your income is not sufficient, or something with your time frame is not sufficient. It is a big mistake to try to match your trading strategies to the deficiencies in your budget, in your household. What you want to do is the opposite. You want to make sure that it actually matches up to what you're doing. But what a lot of people do is they'll think, well, I don't save enough money, so I have to be an aggressive trader. Or I don't make enough money. The median income in the US is what? Like individual income, it's like $46,000 a year. So if you're a person who makes $46,000 a year, you think to yourself, well, I just make a median average income. I don't make enough money. I need to be a super aggressive trader, 3 times leverage. Yeah, you're going to blow up your account. That's what's going to happen. So don't ever match your trading to the deficiencies in your family budget. Fix that so that you don't feel the need to chase. I don't feel the need to triple leverage. I make a decent income. I'm kind of a minimalist. I do travel around the world a lot. So people often say, hey, you're a minimalist, but you live in, you spend $250,000 a year on travel. Well, okay, not a full minimalist, but I don't feel the need to chase performance because I've taken care of everything else and I've given myself another 20 years. Like I'm good. I don't need to try to make 40% a year and then blow up my account. It's just, no, I'm totally comfortable making 12 to 15% a year for the rest of my life. That would be awesome. All right, I'm way over. Last question. Oh, there's another one just popped up. Triple leverage only works if you model the strategy as continual additions. If you park your money in a strat at the beginning, you can't reliably offset the friction of 3 times unless it trends up. Yeah, if it trends up, then of course you can. But what ends up happening, and if you plot, everybody can have a little homework assignment when you go home. Not that I'm a teacher or anything, but if you plot, say, QQQ versus the TQQQ, 1 times versus 3 times, and stretch it out over 15 years, what you will notice is that, of course, the triple leverage does well in good periods, But then that market crash brings it almost back to the same spot as the underlying 1 times leveraged Qs. And then it'll accelerate, and there's the gap builds, and then the next market crash, it narrows and it almost touches. And over again, the 3 times leverage only works under the condition that A, the market is continually going upwards. In that case, it would work. B, that the drawdowns aren't very violent and the gearing effect of 3 times leverage doesn't actually crush you. Because remember, beta slippage works both ways. It actually doesn't always help you. Sometimes it seriously hurts you. And then the third thing would be if you had some type of timing system where every time the market crashes, hopefully you're going to be out fast enough that you don't suffer the full loss. So that's what we do at VTS. That's why I can say that, yes, we do use 2 times leverage. Even though the Qs and the QLD on a long-term buy and hold are pretty much the same when you factor in all the market crashes, I have a timing system where if volatility gets over about 60%, so volatility barometer, if it gets over, say, about here, this level here, my systems will start kicking me out into safety. We'll be getting into cash. If it gets really bad, we'll go long vol. Cash, gold, utilities, cash. This is how I'm beating that long-term equation that keeps knocking them back towards each other constantly. It's this constant game where, you think you're doing great, crashes right back down, right back to the Qs. Think you're doing awesome for 3 years, pandemic happens, it's right back to the Qs again. I'm counting on the fact that while we do suffer drawdowns, they won't be as severe as buy and hold, which means that mine goes up, it goes halfway down to the Qs, and then I go to utilities or cash. And then I can ride the up, it goes halfway down, and that's how I can make forward progress with leverage. But if you don't have a successful, proven track record of a timing system, leverage doesn't improve performance. It just doesn't. It gives the illusion of performance in a bull market, and then you find out very quickly that, oh, wow, I didn't have an edge at all. It met right back to where I started from, right? The old dreaded give back. All right, last question. Is there a significant difference between the 30-part Iron Condor course and the 25-part Iron Condor course stated on the website? There is no difference. It's just that it started out as a 25-part Iron Condor series, and then I stuffed a bunch of extra videos as people were asking questions that I think I missed a few of the important topics. So I turned it into a 30. Come back 6 months from now, it might be the 35-part Iron Condor course. But no, it is the same course. It is that one course that I showed you. And if you are a subscriber, of course, go through it. If you're not a subscriber, go to the free trial on the website and you will gain access to the full course. So it's a free 2-week trial. It's not very self-serving to say this, but 2 weeks should be enough time to get through that course. If you watch a couple videos a day, you should get through it. And then at that point, you can make the decision to just duck out and not pay me any money, or you can actually stick around in the community and learn about the other strategies, the volatility metrics, and basically follow my portfolio. But everybody, I think, would gain some benefit from hopping on that free trial for 2 weeks and ripping through that Iron Condor course. Ask me questions. Of course, come back to the live streams. I answer, as you've seen, I answer everybody's question. I do want to cut it short, though. So it's an hour 14. I missed it. Told you I'm terrible at managing time. But let's cut it there. And next week, we will be back with another topic, another specific volatility topic. So thanks, everybody. Have a good weekend.